All right, the first one that I'm going to look at that I don't think we did in class is the sixth problem on this problem set, I guess in-class problems that covers on the bond market. So it's from the section on interest rates and the bond market. And remember, the final exam, like I told you in the email, is just going to cover the two most recent sections of the course. All right, so let's read the problem here, and then I'll toggle over to the document camera and sketch an answer. We can do that together. So it says, illustrate and explain what happens to bond prices, bond yields, that is interest rates, and the equilibrium quantity of bonds in the following situation. There is a decline in stock market volatility, and the federal government lowers corporate income taxes. So there are two things that are going on here. All right, let me move over to the document camera. And if one of you guys or gals cannot see what's on the document camera, my own written notes here, let me know and I'll try to fix the problem. Okay, so let me draw your attention to the top of the page here. I've got essentially a simple demand and supply model of the bond market, okay? Where we have the quantity of bonds traded in equilibrium on the horizontal axis and the price of bonds, of a generic bond, on the vertical axis. The intersection of these two gives us the equilibrium. So two things are happening in this problem, right? It says that there is a decline in stock market volatility, and there is a cut in corporate income taxes, or in business taxes, let's say. So what should happen then to the price and quantity of bonds in equilibrium? And can you tell me something about the interest rate, or the yield to maturity on these bonds? Anybody want to venture a guess here for me? So this is one of the problems with Zoom classes, is that you guys are more shy than you are in a normal class, in a face-to-face setting. Anybody want to take a guess? I know it's been a while since we covered this material, but it shouldn't be too difficult. What happens to the supply or the demand for bonds if volatility in the stock market was to go down?
That would shift demand to the left.
Okay, Lauren says in the chat box here, if stock market volatility declines, wouldn't the demand shift backward because more investors demand stocks? That's exactly right. So remember, it's the relative risk or volatility of the bond market that is one of the things that determines the demand for bonds. And so here, if the risk or the volatility in the stock market declines, then bond markets become relatively more risky, and you're going to see a left shift in the demand for bonds. Very good. What happens though if business taxes are lowered? Does that affect, you think, the supply or the issuance of new bonds, or the demand for bonds by investors? That, as Lauren says, is probably going to affect supply. And if business taxes are lower, then firms and businesses would be more willing to invest and more willing to borrow in order to finance those investment expenditures. And so the issuance of the supply of bonds would likely shift to the right or increase. And what would happen here is you would see that the equilibrium point would move from here to, let's say, here, where, as I've drawn it, the price of bonds is going to fall and the quantity of bonds traded would also fall. However, you need to be careful about these types of problems in which two events are going on that affect the bond market. You'll notice here that I've shifted the demand curve to the left a little bit more than I've shifted the supply curve to the right. And so on balance, then, there is a reduction in equilibrium quantity. If instead the supply was very sensitive to the reduction in business taxes, then it could very easily be the case that quantities in equilibrium would rise. However, what is unambiguously true is that there would be a fall in bond prices. Okay, so bond prices are going to be lower. Now, what does this imply then about interest rates on bonds or yields to maturity? If bond prices fall as a result of the combination of these two events, we know that bond prices and interest rates are inversely related to one another, right? And so lower bond prices implies higher interest rates. So a decline in stock market volatility combined with lower business taxes should push down bond prices and raise yields in equilibrium. Okay? Anybody have any questions about that one? All right, looks like we're good for the first problem. So let me move on to a second one then, if there are no questions about that. And again, anybody chime in either in the chat box if I can read it quickly enough, or just shout out a question if you want. Let's see here. Let's look at number. So this is the first problem on, I believe, the set of extra problems that are posted on Blackboard. It's number 1 here. The British government sells perpetuities called consols. Perpetuities are illegal in the US. Part A, what will be the market price of a console that pays £100 per year if the market interest rate is 5% per year? B, what will happen to the market price of that console if the interest rate suddenly jumps to 6%? And C, let's say that the current interest rate is 5%, but the price of the console is lower than the amount you computed in Part A. Can you provide a plausible explanation for this? All right. Let me draw your attention here to the second problem on my piece of paper. We have a perpetuity or a console sold by the British government. Part A says that the console pays £100 per year. So that's effectively the coupon payment that is paid annually in perpetuity. The market interest rate is 5% per year. What is then the market price of this console? Well, for that, you need to remember how to compute the present value of a perpetuity. Remember, the market price of any asset should be equal to the present value of all of its future payment streams, okay? The present value of a perpetuity is just the coupon payments divided by the interest rate or the yield to maturity. So for Part A, the coupon payments are £100 per year, and the interest rate is 5% or 0.05. So £100 divided by 0.05 is 2,000 British pounds. So that would be the market price of that console if the interest rate was 5% and the coupon payments were £100 per year. Part B, what happens if to the market price of the console, if the interest rate suddenly and unexpectedly rises to 6% per year? Well, that's very straightforward. The coupon payment is still going to be £100 per year, but the interest rate at which we discount all of those future coupon payments is now 6%. So £100 divided by 0.06 gives us, if I did the math right, $1,666.67, or not cents, or 0.67 pounds, whatever that is. 1,667 pounds sterling, approximately. Okay, what about about Part C? So Part C says the current interest rate is 5%, which would mean that the price should be equal to 2,000 pounds, as we saw in Part A. But instead, the current price of the console in the secondary markets is lower than that. Let's say is 1,667 pounds. Can we provide a plausible explanation for why there is this discrepancy between the price of the console and what the present value of it is based on a 5% interest rate? Any guesses as to what would be driving the difference? Well, remember that financial markets are very much forward-looking, okay? So it could be the case that financial market participants, investors in particular, are anticipating a future increase in the interest rate. Remember, when interest rates go up, bond prices are going to fall. So one plausible reason why the price of the console might be less than 2,000 pounds is because investors firmly believe that interest rates on similar securities are going to be higher than 5% in the very near future, which would push the secondary market price of this console down like we saw in Part B. So the answer to Part C could be a discrepancy between what the interest rate actually is today and what investors think that interest rate might be as early as tomorrow, let's say. Okay, if there are no questions about that one, then let's take a look at number 2 on this problem set. Compute the yield to maturity for each of the following securities. Okay, so for Part A, we have a discount bond, face value 1,000, maturing in 1 year that sells for $926 today. Part B has a coupon bond, and it lists the various characteristics. It tells us the coupon payment, the price today, and the maturity. And Part C is another coupon bond with different characteristics. So this question is a straightforward application of your understanding about how to compute yields to maturity. So to get this one, you have to really understand the basic principle that you definitely need to know for the final exam. And that is that the yield to maturity is the interest rate that balances or equates the price of a security to the present value of its future payment streams from owning that security. All right. Now look, sometimes it is easy enough to solve for the interest rate analytically or by hand or with a simple calculator. Other times, however, that present value formula is complicated enough that you're going to need to enlist the help of a computer. There is this spreadsheet program, financial calculator, that we can take a look at to solve parts B and C. Or alternatively, if you guys have a financial calculator and you want to use that, you're more than welcome to do so. So let's work through these examples here. All right, so part A of this problem asks you to find the yield to maturity on a discount bond with a face value of 1,000, maturing in 1 year, that sells for $926 today. So here we have N as the maturity. Here's the price of the bond. Here's the face value. Can we find what the yield to maturity is, or the interest rate? Sure. We know that the price of the bond, $926, has to be equal to the present value of its future payments. Well, with a discount bond, you're only going to receive the face value at maturity, which is 1 year from now. And so that would be 1,000 divided by 1 plus I. If you solve this equation for I, what I think you're going to find is that I is approximately equal to 0.0799, something like that. So basically equal to 8% per year. Right, remember, on these simple discount bonds, the interest rate is basically just equal to the face value of the bond divided by the price of the bond, 926, minus 1. That's equal to 0.08, or 8% per year. What about B? So here we have a coupon bond that has a face value, or a par value, of $1,000. Annual coupon payments of $80, that sells for $1,050 right now, and has a maturity of 2 years. How can we find the yield to maturity? Well, you're going to have to use a financial calculator or the spreadsheet program to actually solve this, which I wouldn't require that you guys do on an exam. What would be sufficient for me is that you understand the equation, can write down the equation that is consistent with the correct yield to maturity. So let's do that for this one. In this case, the price of the bond, $1,050, needs to be equal to the present value of all of its future payment streams. Well, at the end of the first year, you get an $80 coupon payment, discounted back 1 year, so divided by 1 plus I. And then at the end of the second year, you get an additional $80 coupon payment, discounted back in present value terms 2 years, so divided by 1 plus I squared. And then you're also going to get the par value, or the face value of the bond, which is $1,000, and its present value is 1,000 divided by 1 plus I squared. Hopefully you see there that that's basically a quadratic equation in the interest rate, okay? So writing this expression would be sufficient for me that you understand how to compute yield to maturity. It's the interest rate that balances the price of the bond with the present value of its future payments. If you want to actually solve for the interest rate, however, you're going to need to punch this into a calculator or use a computer. So let me go ahead and do that. I've got my spreadsheet program that we can use as an example. So here is the sheet in which you can try to kind of figure out, or reverse engineer, if you will, what the yield to maturity is. So in this case, I believe the coupon payment was what, $80? The face value of the bond was $1,000, sorry. And the security price, or the price of the bond, was $1,050. And the number of periods, or years in this case, until maturity is equal to 2. So remember how we use this spreadsheet is that you have to kind of look at a range of different interest rates and then sort of zero in on what the exact interest rate would be, at least to the hundredths of a decimal point. So let me consider interest rates between 1% and let's say 20%. And you'll see here that the difference between the price of the bond in column D and the present value of its future payments, given by this column F error, goes from being a negative number to being a positive number, somewhere between 5 and 5.5%. So let me go back and refine my grid, and I'll start with 5% and go up by increments of, let's say, 1 basis point at a time, and see if that's enough to get there. It looks like it is. It looks like the interest rate that balances the price of the bond to its present value is about 5.3%. That's a clumsy way of calculating it using Excel. I'm sure you guys have a program or a financial calculator that can do a better job than that. And that is okay. All right, let me go back to part C now. This one is a little different. So part C says a coupon bond with a face value of 1,000 and has a 6-month or a semi-annual coupon payment of $50 that sells for $1,025 today and matures in 5 years. If you see one like this on the exam, be careful that you've got the right frequency here, okay? The period that the discounting occurs is every 6 months, okay? But the maturity is listed in years. And so the maturity period is actually going to be 10 6-month periods. So make sure you have the right number there. So to calculate the yield to maturity, the price of the bond, 1,025, has to be equal to the present value of its future payments. Well, after the first 6 months, you're going to get a $50 coupon payment, discounted back one half year. At the end of the second 6-month period, you'll get another $50 payment, discounted back 2 periods, which would be 1 year in this example. And this is going to go on for all 10 payment periods, plus the discounted value of the face value of the bond, which is 1,000 divided by 1 plus I to the 10th. This equation here is sufficient to characterize what the correct yield to maturity is. But you have to understand, again, that the interest rate is not the annual interest rate, but rather it's the semi-annual interest rate. But it's really easy to convert a semi-annual interest rate into an annual interest rate, right? All you do for that is simply take the semi-annual interest rate, 1 plus I, and you square it to give you the gross annual interest rate. So if you can figure out the yield to maturity from this problem, then it's really easy to calculate the annual yield to maturity. And once again, we can just make use of our handy dandy little financial calculator in Excel. Oops. All right, for this one, what do we have? We have coupon payments that are $50. The face value of the bond is 1,000. The security price is 1,025. And the number of periods to maturity is 10, because it's a 5-year period with semi-annual payments. So let's start at a 1% yield to maturity and go up by increments of 50 basis points, just like we did earlier. What we see here is that we go from negative to positive on on that error column somewhere between 4.5% and 5%. So if I were to concentrate or make the grid of interest rates finer, I would discover that the proper yield to maturity is closer to 4.68%. Okay, now again, that is the semi-annual interest rate. Okay, if you wanted to find the annual interest rate, let's call that 1 plus I superscript A, that's just going to be equal to the semi-annual interest rate squared. So you can just plug in 0.0468, add a 1 to it, and then square it, and you can figure out what the annual interest rate would be. That's really not as important though. What's important is that you guys be able to get the correct yield to maturity on a semi-annual basis. That one's a little bit trickier because the frequency here is a 6-month period instead of a year. Okay, any questions so far? Let's take a look then at number 3. Assuming that the current interest rate is 3%, compute the present value of a 5-year, 5% coupon bond with a face value of $1,000. What happens when the interest rate goes to 4%? What happens when it goes to 2%? Okay, so this is a very related problem to the previous one, except we now want to know what happens to the price of the bond when the interest rate changes suddenly. All right, let me draw your attention to the top of the page here then. So for the first part of the problem, it says, again, assume that the current interest rate is 3%. Compute the present value of a 5-year coupon bond that has a face value of $1,000 and has a 5% coupon. It's a 5% coupon bond, meaning that the annual coupon payments are $50 a piece. All right. So what would be the price then of that 5-year 5% coupon bond? Well, here we can simply plug this into. We can either write out the entire present value formula, which would be sufficient, which is what I did on the previous problem, or alternatively, you can use the closed form solution for the present value of a coupon bond that is also in your slides. Let me present those on this one just to mix it up a little bit. So the present value of this coupon bond would be the coupon payment of $50 times 1 minus 1 divided by 1 plus the interest rate, which is 3% in this problem, raised to the maturity date of 5 years, divided by the interest rate of 3%, so 0.03, plus the present value of the final face value of the bond, which would be $1,000 divided by 1 plus 0.03 raised to the 5th power. Now, if you compute all of that carefully, hopefully, if I did this right, you're going to find that this bond will cost $1,091.59. So that is just a straightforward application of the formula that we presented in class. what happens if the interest rate goes to 4%? Well, this is really easy, right? You just apply the same formula, but you change the 0.03s to 0.04s, okay? So again, $50 times 1 minus 1 divided by 1 plus 0.04. The fifth divided by 0.04 plus 1,000 divided by 1 plus 0.04 to the fifth. And that is going to equal $1,044.52. And as expected, as the interest rate rises, as the yield to maturity rises, you discount future coupon payments and future payments more heavily. And so the present value of the bond is going to shrink. Right? The price of the bond is going to fall by around $45 in this case, as the interest rate rises. Now, what happens to the same bond if the interest rate goes down instead of up, this time to 2%? Well, I'll spare you the writing out the formula again. It's the exact same formula. You just change all the 0.04s to 0.02s, and you're going to find that the price of the bond is $1,141.40. And again, as expected, the bond price is going to go up if the interest rate falls. If current interest rates are falling, existing bonds are more attractive compared to newer bonds. And so their prices are going to be higher in secondary markets. You don't discount their future payments as heavily any longer. Okay. Any questions about that one? All right, I'm going to take your all silence as fully understanding this stuff. Okay, let's do one more of these before we move on to the term structure material. Let's say I told you that your firm has the opportunity to buy a perpetual motion machine to use in your business. The machine cost $1 million and is expected to increase your profits by $75,000 per year. What is the yield to maturity for this asset? Well, hopefully you see that this particular asset is going to behave exactly like a perpetuity. It is a machine that is expected to generate $75,000 worth of additional profits every year forever. And so if the machine costs $1 million up front, we should be able to figure out what the proper yield to maturity on this asset is. Remember, the price of a perpetuity is just equal to the coupon payments, right, divided by the interest rate. Well, in this case, we know that the machine costs $1 million. It's expected to generate $75,000 worth of revenue, additional profits every year. What we don't know is what the implied interest rate or yield to maturity is. Well, we can simply flip this equation on its head and find that the interest rate or the yield to maturity is 75,000 divided by 1 million. And that is going to give us 0.075 or 7.5%. A simple, straightforward application then of using the formula for a perpetuity. actually, let me do, before we move on to the next one, let me do one more problem here from that same set of practice problems. And that's number 5 here. So this one's going to be, again, a quick little application of your understanding of how to look at the bond market in order to figure out what happens to bond prices and yields. So explain and illustrate what will happen to bond prices and yields and possibly the quantity of bonds in each of these situations. Okay, so there's 4 of them. Let me switch over to my, to work out the solution, and I'll just kind of read the situations to you one at a time here. Okay, so I've drawn 4 separate graphs here for parts A through D. In part A, it says that wealth in the economy increases at the same time that Congress raises the corporate income tax. So there's a wealth increase and also an increase in business taxes. How is that going to affect the bond market? Well, remember, one of the determinants of bond demand is investor wealth. So if wealth increases, that should shift the demand schedule for bonds to the right. However, if business taxes are increased, businesses are going to be more reluctant to want to invest in projects, capital projects. And so they're probably going to issue fewer bonds. That is, they're going to borrow less from the public in order to finance those capital expenditures. And so it's likely that the supply curve for bonds is going to shift left as well. As a result, we're going to have bond prices rising, but the effect on quantity is going to be ambiguous. It'll depend on which shift is bigger, demand or supply. And so if bond prices are rising, then that means the interest rate should fall. So an expansion in wealth, but an anticipation of higher business taxes should put downward pressure on yields to maturity. The second one says that the economy experiences a business cycle expansion. Well, in one way, this is like part A, right? When the economy is expanding, it's on an upswing, investor wealth grows, and so that's going to increase the demand for bonds, just like part A. What's different from part A, however, is that as the economy expands, businesses are going to regard their investment opportunities as being potentially more profitable. And so they're more likely then to issue bonds to finance those capital expenses. Now, the way I've drawn it here on the graph, I've got an increase in quantity and a small increase in price. However, hopefully you see here that depending on the size of the shift in supply versus demand, the bond price might rise or fall, okay? Which means that in equilibrium, bond interest rates could go up or they could go down, that there is an ambiguous effect. The quantity of bonds traded in markets is unambiguously going to increase, but since the price movement is uncertain, we can't be for certain what's going to happen to the actual interest rate. Right? When 2 things happen in these models, you are almost always going to find that one of the 2 margins, either price or quantity, is ambiguous.
For questions like that on the test or the
Right.
lab, would you like us?
That the government removes tax credits for business investment and spends the additional funds on a new education program. So on balance, fiscal changes have no effect on the status of the government's budget. Okay, that's important because, first off, if the government removes a tax credit for business investment, that is tantamount to an increase in business taxes, which, as we saw from Part A, is going to shift the supply curve for bonds to the left. So the removal of tax credits is essentially the same thing as an increase in taxes. So bond supply should shift left. Now, if the government uses this new revenue to finance an education program, and so it has no effect on its budget, then the government is not going to have to increase its borrowing or decrease its borrowing by any amount. And so there's going to be no effect on the supply of bonds from the government due to a change in the budget deficit or surplus. And so then what's going to happen is that there will be an unambiguous reduction in the quantity of bonds and an unambiguous increase in the price of bonds in equilibrium. Therefore, the interest rate on bonds should fall. Okay, the last one. Okay, we got a question from Lauren here. For questions where there's an ambiguous effect, would you like us to clarify the effects are ambiguous or just go? Okay, so that's a good question. So again, let me restate what Lauren is asking here. If I give you a problem on the final exam where there is an ambiguous effect, what I want you to do is be able to demonstrate that on your exam. So you would either want to draw two graphs which show the curves shifting by different amounts, or you could even graph it on the same set of axes to illustrate the point that one of the two margins, either price or quantity, is going to be unknown in terms of its change because we don't know what the relative size is. So yeah, don't just go with what's on your initial graph. You have to indicate to me somehow you understand that either price or quantity is going to have an ambiguous effect. So for Part D, it says all leading indicators point to stronger economic growth in the near future. Okay, but it also, so economic growth is going to rise, but at the same time, the response of bond issuers dominates the response of bond purchasers. So this problem D is just like Part B, except we have one additional piece of information. And Lauren, this really addresses your question in kind of a roundabout way. If economic growth is expected to expand, that is, we're in a business cycle expansion, then the demand for bonds is going to shift to the right because of increases in wealth. And the supply of bonds is going to shift to the right because investors are viewing their capital projects as potentially more profitable. But the problem says that the response of bond issuers dominates the response of bond purchasers. That little nugget of information tells you that the supply of new bonds is going to be more sensitive than, or larger in terms of its shift than the shift in the demand for bonds. So you can draw that graph kind of like this, in which case the quantity of bonds is going to increase in equilibrium, and we will know for certain then that bond prices will fall in equilibrium, which means interest rates will rise. So that little extra piece of information that tells you the supply effect is bigger than the demand effect enables us to determine whether or not prices and interest rates go up or down. Okay, any other questions then about that one? Let me now move on to the next topic on the term structure and see if I can't do a few of these. We've covered this material a little bit more recently, so hopefully we won't have to do quite as many of these. Okay, what can I get rid of here? That's gone. Okay, so Let's take a look at number 2. I don't think we did this one in class. Following a policy meeting, on March 19th, 2009, the Federal Reserve made an announcement that it would purchase up to $300 billion worth of long-term U.S. Treasury securities over the next 6 months. What effect might this policy have on the yield curve? Okay, the Fed announces that it's going to purchase a whole lot of long-term Treasury securities in the near future. How might that affect the shape of the yield curve? All right, let me draw your attention here to this one that I've got labeled as yield curve. So I've got 2 graphs here. The graph on the left is a supply and demand model for long-term treasuries, okay, where the equilibrium occurs here at this intersection point. On the right here, I've sketched just kind of a generic treasury yield curve, where hopefully you guys remember what the yield curve measures. It shows us what the current interest rates are on treasury bonds of different maturities, from very short maturities of as short as 1 month to long maturities of as much as 30 years. What the problem says is that on March 19th, 2009, so on this date here, the Fed made this announcement that it's going to purchase $300 billion worth of longer-term U.S. Treasury securities. Well, if the Fed announces that it's going to purchase in secondary markets a whole bunch of these longer-term treasuries, we know that that is going to push up the demand for long-term treasuries in secondary markets. And given our understanding of how bond markets work, that should both increase the price and increase the quantity of long-term treasury securities circulating or that occur in equilibrium. And of course, if the price of those treasury securities goes up, then that means the interest rate or the yields on those securities are going to fall. At least that's what the bond market model would predict, okay? So hopefully you can see here that we will see how the yield curve may actually shift. For these maturities at longer dates, we would expect the interest rates to be lower in the future as the Fed increases its demand for those long-term treasuries. And so my guess is that the yield curve might end up looking something like this on the very next day, 3/20/09. And so the far end of the yield curve is going to kind of shift down in a clockwise fashion because the Fed's purchase of these long-term treasuries drives up the price and lowers the yields or interest rates. Now you guys, I'm not going to do this today, but if you want, you can go back and take a look at data from the Treasury's website before March 19th, 09 and a few days after March 19th of 09 to see whether or not the yield curve indeed kind of shifted down in that clockwise fashion. I recall doing that at one point, and the data does bear out what is in the model. Okay, questions about that one? All right, let's take a look at number 3. Complete the following table using the pure expectations theory of the term structure. Okay, so here's a simple table that has some data. We've got dates 2018 through 2021, and then we've got, let's see, time until maturity in terms of years. So for instance, what this, just so you guys can read this correctly, what we're looking at here is this is effectively data from the yield curve in 2018. And these are just made up numbers, by the way, okay? So in 2018, the current 1-year interest rate is 3%. The current 2-year interest rate is 3.8. the current 3-year interest rate is 4.2, and the current 4-year interest rate is 5%. Basically, what this problem is asking you to do is to fill in the blanks, that is, find the 1, 2, and 3-year interest rates in 2019 through 2021 using information only in the 2018 yield curve. We can do this by applying the proper formulas given to us by the pure expectations theory of the term structure. So let's review that. All right, so I've reproduced the graph here from the problem set onto my paper. Right, so again, here is what the yield curve looks like hypothetically, let's say in 2018. 3%, 3.8, 4.2, and 5% on bonds of 1, 2, 3, and 4-year maturities. Let's first figure out what the 1-year bond rate is expected to be in 2019, 2020, and 2021. And we want to do that by applying our understanding of the pure expectations theory of the term structure. Now, let's be careful about this. And again, if anybody has questions, feel free to just shout it out. How do we find the interest rate on the 1-year bond that prevails in 2019? Well, according to the expectations theory, sorry about the focus seems to be going in and out. I apologize. It should be equal to, let's see, the 2-year interest rate in 2018 should be equal to the average of the 1-year interest rate in 2018 and the 1-year interest rate in the next year, right? And so 3.8% should be equal to the average of 3% and whatever the interest rate is expected to be on the 1-year bond rate next year. Let's just call that X divided by 2. And in a minute, I'm going to drop the percentage signs just to save time. We understand that all of these numbers are written in percentage points. So this becomes what? If I multiply both sides by 2, you get 7.6, and then subtract 3. And so the interest rate then that is expected on 1-year bonds in 2019 is just going to be equal to 4.6%. The 4.6% goes in that cell. What is the interest rate expected then in 2020? Well, we can figure that out by using information on the current 3-year bond rate, right? The 3-year bond rate in 2018, which is 4.2%, should be equal to the average of the current 1 year, next year's 1 year, and the 1 year 2 years from then. So that is equal to 3 plus 4.6 is the 1-year rate we just found in 2019, plus X, which is the 1-year rate for 2020, divided by 3. If we multiply this equation by 3, you get 12.6, and then subtract 3 and subtract 4.6, and you're going to get that the 1-year rate expected in 2020 is just 12.6 minus 3 minus 4.6, which is 5%. Now, what about the 1-year rate expected in 2021? Well, you guys can hopefully see the pattern here. The current, or I should say the 4-year bond rate in 2018, which is 5%, should be equal to the average of the 1-year rates over the current year and the following and the subsequent 3 years. So that's 3 plus 4.6 plus 5 plus X divided by 4. So 20 minus 3 minus 4.6 minus 5 is equal to X. And the interest rate on a 1-year bond expected in 2021 should be equal to, I think, 7.4%. Right? So if we make use of the expectations theory of the term structure, we can actually infer what future interest rates are going to be simply by looking at current interest rates on bonds of all of these different maturities. So we've got this one done, and this one done. Well, how about the 2-year bond rate that prevails in 2019 and the 3-year bond rate that prevails in 2019? As well as the 2-year bond rate that would prevail in 2020. How do we find those? Well, we find those in exactly the same way, by recognizing that the 2-year bond is just the average of the current and expected future 1-year bond. So for instance, let's say we're looking for this interest rate. That's the interest rate on a 2-year bond that prevails in 2019. What should it be equal to? It should be equal to the average of the 1-year bond in 2019, which we found was 4.6%, and the 1-year bond in the next year, that is 2020, which we found to be 5%. The average of those two is 4.8%. So that is what the 2-year bond rate is expected to be then in 2019. That is that number. What would the 2-year bond rate be in 2020? Well, the expected 2-year bond rate in 2020 should just be equal to the average of the 1-year bond rates in 2020 and 2021. So that would be 5% plus 7.4% divided by 2 gives us, I think, 6.2%. And that takes care of this one. Finally, if I want to figure out what the 3-year bond rate is in 2019, I just recognize that it's the average of the 1-year bond rate in 2019 and the 1-year bond rates in the next 2 years. So that's 4.6 plus 5 plus 7.4 divided by 3, which I think is equal to 5.67%. So the strategy for that one is obviously to figure out what the 1-year bond rates are going to be in all of the years. And then you use that information to determine what the interest rates on the longer term bonds are going to be in years after 2018. Okay, are there any questions about that one? That one I might have been a little bit complicated, so please feel free to ask me whatever. Okay, the last set of problems that I have are more conceptual problems involving or testing your understanding of the term structure of interest rates. So let's go through a few of those in the time that we have remaining. The first one, the following is an article from the Wall Street Journal appearing back in 2008, describing events in the market for Treasury securities on that day. Quote, Treasury prices were mixed, with the shorter end of the curve rising and longer dated treasuries falling in price. On a graph, draw two Treasury yield curves, one showing the situation at the end of that day, as described in the quote, and one showing the situation at the end of the previous day. All right? So basically, we want to take this quote from the Wall Street Journal and think about how it's going to affect how the yield curve should be affected by this. Let me draw your attention here to the top of this page. So the problem says Treasury prices were mixed. So it's not telling us directly what happens to yields, but rather prices. With the shorter end of the curve rising in price and longer dated treasuries falling in price. So here, let's just say that this is what the yield curve looks like yesterday, where we have maturity on the horizontal axis and interest rates on bonds of different maturities on the vertical axis. If short-term bond prices are rising, then that means interest rates on short-term bonds are going to be falling, right? So let's call it I short should be going down. If long-term bond prices are falling, that means interest rates on long-term bonds, I long, should be rising, given the fact that bond prices and interest rates are inversely related to one another. So relative to what the yield curve looked like yesterday, we'll just assume it has this kind of normal upward slope to it. The long end of the yield curve should generate higher interest rates because long-term bond prices are falling, and the shorter end of the yield curve should have lower interest rates because short-term bond prices are rising. So what we would expect to see happen would be for the yield curve to kind of tilt at some point in the middle maturity range there, to where long-term yields are higher, but short-term yields are lower. In other words, the yield curve is kind of twisting. It's not rotating close to the origin like we saw in some of those other examples, but more or less twisting at some maturity level that's sort of in the middle between short and long maturity debt. The problem doesn't give us anything specific about at what date that occurs, what maturity that occurs, but there would be some point at which the yield curve would kind of twist. Questions on that one? How about number 2? What would happen to the yield curve if investors were concerned about instability in foreign countries and rushed their money into the United States to buy long-term Treasury securities? This is an example of the so-called flight to safety phenomenon. How would you expect the term premium to change? All right, this is a common phenomenon in financial markets because global investors regard the US dollar and US assets, or treasuries in particular, as being very safe and a low amount of default risk. When there are instabilities around the rest of the world, oftentimes we have this flood of money into treasury securities, okay? What would be expected to happen to the yield curve as a result of that flight to safety phenomenon? In particular, what would we expect to see happen to this so-called term premium? Now, hopefully you guys remember what the term premium is. The term premium is the extra bit of yield that investors require in order for them to want to purchase long-term treasuries over a sequence of shorter-term treasuries that don't have as much interest rate risk. Okay, let's examine this by again looking at the bond market for long-term treasuries and thinking about how that's going to affect the yield curve, which is what I have over here on the right. So here we have a market for long-term treasuries. If global instabilities lead to a large flight to safety, then what is going to happen? The demand for long-term treasuries is going to shift to the right. That, of course, is going to push up equilibrium long-term treasury prices, increase the quantities traded, and therefore lower long-term treasury yields. Okay? So this flight to safety, we would expect to see it put downward pressure on long-term treasury interest rates. All right? Now, let's suppose that this is what the yield curve looks like in the previous day. It has its standard kind of upward slope. Now, the only other thing that I've graphed here is I've got this horizontal line where the reason why I'm drawing that is that the vertical distance from this horizontal line where we've got the yield on a short-term treasury versus the yield on a long-term treasury effectively tells us what the term premium is going to be, right? And remember, the term premium rises as the maturity gets longer, which is this reason why yield curves are usually upward sloping, okay? Now, if we see this large flight to safety, then interest rates on long-term treasuries are likely going to fall. And so the yield curve is probably going to do something like this, where this would be today's yield curve relative to the previous day. So interest rates, we already know, are going to fall, but if short-term treasuries don't change in terms of their interest rate, what that means then is that the term premiums are getting smaller. So one thing that could actually affect the term premium is investors' perceptions of how much risk is out there in the economy. And if the rest of the world is looking more risky relative to US treasuries, then these term premiums can actually fall. Okay, questions about that one? Let me try to do at least one more here. I know I'm sort of running out of time, but I think number 3 is interesting. So according to the liquidity premium theory, if the yields on both 1- and 2-year bonds are the same, would you expect the 1-year yield in 1 year's time to be higher, lower, or the same? Explain your answer. All right, now be careful about this one. If you see that essentially the yield curve is flat, that is, the 1-year yield is the same as the 2-year yield, if you view that data through the lens of the liquidity premium theory, what must you expect the 1-year interest rate to be 1 year from now? Higher than it is today, lower, or the same? And explain your answer. Well, let's talk about this in words. I mean, does anybody want to offer a potential solution here? Do you guys have any ideas? Or you just prefer me to explain it? That's okay to do. Remember, a flat yield curve according to the expectations theory, suggests that interest rates are going to remain constant for a period of time. But when we view that data through the liquidity premium theory, we know that a flat yield curve actually signals that interest rates are going to be declining in the future. And why is that? Because longer term bonds have built into them this positive term premium, which means then that if longer term bonds are the same as short term bonds, it must be the case that future short term bonds are actually going to be lower. So a very flat yield curve viewed through the lens of the liquidity premium theory would suggest that interest rates are going to be declining. Now we can actually illustrate this mathematically if you kind of follow the logic here, and I don't think this is too difficult. Imagine taking a 2-year bond, IT2 today. That, according to the liquidity premium theory, should be the average of the 1-year bond today, the 1-year bond expected next year at T plus 1, so divided by 2, plus this term premium. This sigma 2 is the term premium. That's the extra yield that you've got to provide an investor in order to get them to buy the 2-year bond instead of a sequence of 1-year bonds. Okay, if I tell you that the current 2-year bond is equal to the current 1-year bond, in other words, the yield curve is perfectly flat at maturities of 1 and 2 years, let's just call that interest rate I, okay? That I2 and I1 is just equal to some I interest rate. They're the same. Then let's do a little algebra here. If we multiply both sides of this equation by 2, you get 2 times I2t would be equal to I1t plus the expected 1-year rate next year plus 2 times the term premium sigma 2t. Now, if I'm assuming that the interest rate on the 2-year bond, which I just called I, is the same as the interest rate on the 1-year bond, again, that's just I, and I subtract I from both sides of this equation, you get 2I minus I is just I is equal to the expected 1-year rate next year plus 2 times the term premium. Well, that means then that the rate expected on 1-year bonds next year is equal to the interest rate on 1-year bonds this year, as well as 2-year bonds this year, minus 2 times the term premium. And since the term premium is greater than 0, this is a positive amount of additional yield that one has to provide investors in order for them to purchase the 2-year bond. This implies then that the interest rate expected on a 1-year bond next year is less than the current 1-year interest rate, right? And so a flat yield curve viewed through the lens of the liquidity premium theory suggests then that 1-year interest rates are going to be lower than what they are this year. A downward sloping or an inverted yield curve therefore means that short-term interest rates should be falling by a lot in the near term, which is, as we've talked about in class, a signal of a potential future recession, right? If investors think that, for example, the Federal Reserve is going to cut short-term interest rates in order to combat a recession, then we might find that current short rates are actually higher than current long rates. And the yield curve would therefore be inverted. Okay, that's about an hour and 20 minutes worth of practice problems. I have a couple more, but I think the answers are also on the website. If you guys want to work on those on your own. And if you have any questions about them, feel free to email me. First off, before we leave here, do you guys have any questions then about that last problem or anything else we did today or anything about the final exam? I think I hopefully clarified the aspects of the final exam in my email to you the other day. Again, it's not going to be comprehensive. It's just going to cover the stuff on the bond market and present value, as well as the term structure of interest rates. The setup will be the same, 12 multiple choice, 8 free response questions. I guess really the only difference is you'll have to do it remotely while sitting in front of your webcam, which is, I know, a bit awkward, but it is what it is. You'll have a full 2.5 hours to take it. I don't anticipate you guys needing that amount of time because it's no longer than any of the other exams. I'll be available to answer questions in the chat box if you need. And that's really about it. Anything else? All right, well, good luck with your final exams. Let me know if y'all have any other questions before your exam date, which I believe is next Wednesday. And then, like I also said in the email, I'm going to make your lab available probably tomorrow morning around 11 o'clock. And I'll give you kind of a full day to do it. So just make sure you get that back to me by let's say the end of the day on Wednesday. And if you can, please, please, please email your labs and your exams to me as a PDF file. That will make my life a lot easier. Okay? See you, everybody.